Thank you very much for joining AnyMind Group Incorporation's earnings briefing for the third quarter of fiscal year 2024. I am Sogo, CEO of AnyMind Group. Let me begin with our third quarter highlights. In the third quarter of 2024, our company continued the strong growth momentum from the first half. We achieved significant growth with a 53% year-on-year increase in revenue, and gross profit also showed remarkable growth of 46% compared to the same period last year. In terms of profitability, we achieved substantial year-on-year profit growth, with operating income reaching a record high of 708 million yen and adjusted EBITDA of 1 billion yen. Furthermore, given that our performance through the third quarter has significantly exceeded our initial expectations, we have revised upward our full-year earnings forecast for all profit indicators. Here are the contents for our earnings material. Let me start with our financial results for third quarter 2024. Here is a summary of our consolidated financial results. Our revenue reached 13.1 billion yen, up 53% year-on-year, while gross profit increased 46% to 4.8 billion yen. This growth includes a positive currency impact of approximately 2.0% from Asian currency fluctuations against the yen. Operating profit reached 708 million yen, and profit attributable to owners of the parent was 378 million yen, showing significant improvement from the same period last year. We recorded a non-operating foreign exchange loss of approximately 138 million yen due to the yen's appreciation from 161 to 143 against the dollar between June and September. This is an unrealized valuation loss on our USD-denominated assets and is considered a temporary event. Here is our progress against the revised full-year forecast announced in August. Both revenue and gross profit are progressing at a rate exceeding our plan. In addition to revenue outperformance, operating profit is also significantly ahead of plan due to continued improvements in productivity. Looking at our quarterly performance trends shown here, all business segments are demonstrating steady growth. I will provide more details on this later in the presentation. I will now explain our results by region. First, let me highlight a change in our disclosure method. Previously, we reported regional revenue ratios on a financial accounting basis. However, due to increasing discrepancies between financial and management accounting figures in our rapidly growing creator business, we have switched to management accounting-based disclosure specifically for creator business revenue. Regarding regional revenue distribution, Japan and Korea accounts for 38%, Southeast Asia 45%, and Greater China and India 18%. For gross profit, the breakdown is Japan and Korea at 45%, Southeast Asia at 40%, and Greater China and India at 14%. In terms of growth rates, Southeast Asia achieved particularly strong growth at 102% year-on-year, while Greater China and India grew by 48%. Japan and Korea also maintained growth at 14%, demonstrating positive momentum across all regions. In Southeast Asia, we've seen robust performance across all business segments, driven by expansion in our strategic EC business, steady growth in creator growth, and strong marketing business. Greater China and India regions have shown strong growth led by marketing and partner growth businesses. While Japan and Korea experienced some growth rate slowdown in publisher growth segment from Q2, other segments, including marketing and D2C EC businesses, maintained growth momentum, achieving stable overall growth. In conclusion, the third quarter demonstrated continued progress in our global revenue diversification strategy and sustainable growth across regions. Operating profit for the third quarter of 2024 reached a record high of 708 million yen, an increase of 486 million yen compared to the same period last year. Similarly, adjusted EBITDA improved to 1 billion yen for the third quarter. Let me explain the trends in our selling, general and administrative expenses. In the third quarter of 2024, our SG&A to gross profit ratio was 85%, an improvement of 8 percentage points compared to the same period last year. While personnel expenses are increasing in line with business expansion, we are implementing appropriate cost controls to ensure that personnel cost growth does not exceed revenue growth. As a result, although personnel expenses account for more than 50% of total SG&A, we continue to invest in recruitment for growth while steadily improving profitability. As a key indicator of our improved profitability, we track gross profit per employee over time. Currently, we are focusing on deepening our business foundation in existing countries and business segments. Through the promotion of gradual productivity improvements and efficient business operations, gross profit per employee shows a steady upward trend. We consider the continuous improvement of this metric a critical management priority. Additionally, our planned talent acquisition is progressing smoothly, enabling us to achieve sustainable growth while balancing productivity improvements with business expansion. Moving on to our balance sheet. While actively pursuing M&A opportunities, we have maintained strict investment discipline with thorough due diligence processes. As a result, the goodwill from our 9 completed acquisitions stands at 2.7 billion yen, with a goodwill to equity ratio of 0.18 times, maintaining a healthy level. Looking ahead, we will strategically leverage debt financing while maintaining an appropriate balance between cash reserves and strategic investment opportunities. Our policy remains focused on delivering long-term shareholder value while maintaining a strong balance sheet. As explained in our previous discussion, our performance through the third quarter has exceeded our plan. Given our business seasonality, where the fourth quarter typically represents our peak season, we anticipate further upside potential and have revised certain performance indicators upward. Regarding revenue and gross profit, despite performing above expectations, we have decided to maintain our current full-year forecast, taking a conservative stance. However, we have revised our profit guidance upward, reflecting steady improvements in profitability. Our updated full-year forecasts project operating profit of 2.4 billion yen, representing a 221% increase year-on-year, and net income attributable to owners of the parent of 1.58 billion yen, up 182% from the previous year. For our progress against the revised full-year guidance through the third quarter, our year-to-date progress rate stands at 73% for revenue and 72% for gross profit, both exceeding the progress rates seen in fiscal year 2023. For operating profit, we have achieved a 70% progress rate, which significantly outpaces last year's progress rate of 44% at the same point. Similarly, net income attributable to owners of the parent is tracking ahead of last year's progress rate. Given our fourth quarter seasonality, there is potential for all metrics to exceed our forecasts. However, we have maintained a conservative stance by including some buffer in our projections. We are firmly committed to surpassing these revised forecasts. This slide explains the assumptions underlying our forecast. Changes from our previous guidance are highlighted in red, though there are no significant changes associated with this upward revision. Based on our historical progression, we expect the operating profit margin to improve from 2.2% in the previous fiscal year to 4.9% in the current fiscal year. As summarized here, our performance has progressed well in line with everything I've explained. Let me explain our basic policy regarding shareholder returns. The Asian markets where we operate present abundant opportunities for growth and M&A investments. We believe prioritizing growth investments over dividends will maximize shareholder value. Therefore, we intend to pursue further business expansion by leveraging our high growth potential. We will also consider flexible implementation of share buybacks when stock prices are at attractive levels to enhance shareholder value. These treasury shares can be effectively utilized as stock consideration in M&A transactions, helping align interests with founders of target companies and supporting our growth strategy. Moving forward, we will continue to pursue flexible capital policies based on market conditions, always focusing on maximizing long-term shareholder value. We appreciate your continued understanding and support. Next, I will provide detailed explanations of our business segments. In the third quarter, all business segments achieved year-over-year growth, with gross profit increasing 33% in marketing, 65% in D2C e-commerce, and 56% in partner growth. Our consolidated gross margin remains stable at 36%, consistent with historical trends. While all segments are showing strong growth, the partner growth and e-commerce businesses stand out with particularly high growth rates and increasing shares of our business mix. For the third quarter, marketing accounted for 47% of gross profit, D2C e-commerce for 19%, and partner growth segment for 33%. This balanced growth across segments is creating opportunities to strengthen cross-segment synergies, particularly through cross-selling initiatives. Our marketing segment achieved 33% year-over-year growth in gross profit, significantly outpacing industry averages. Looking at regional performance, Southeast Asian markets have been particularly strong, with Thailand, Indonesia, and the Philippines driving growth. These regions are showing robust demand, especially in influencer marketing, which has been a key contributor to our business expansion. AnyTag, our core marketing business platform, provides end-to-end influencer marketing support, from influencer selection and analytics to campaign management and performance measurement. The platform enables easy implementation of performance-based and open recruitment campaigns, with real-time tracking of post effectiveness. Recently, we integrated generative AI capabilities that leverage data from over 4,500 historical campaigns to automate the creation of campaign briefs and PR content. This enhancement improves operational efficiency while enabling higher quality content production. Our D2C e-commerce segment posted strong growth of 65% year-over-year. In our B2B e-commerce business, our group company in Malaysia through M&A, Archie Digital, started to contribute to our results from June in Q2, and the new client acquisitions in Thailand, Singapore, and the Philippines drove further business expansion. Regarding the gross profit margin of our D2C e-commerce business, we've seen a decrease in margin due to DDI, our acquired Indonesian company, which operates with an inventory holding business model and is subject to local regulations. However, excluding DDI, the gross profit margin in the third quarter remained stable at 56%, consistent with historical trends. The number of brands handled, a key KPI for our e-commerce business, continues to grow steadily, reaching 218 brands in the third quarter across both creator and enterprise support segments, including 19 brands by DDI and 12 brands by Archie. Our enterprise e-commerce support services shows growth in cross-border transactions and major global brand partnerships, driving increased per-brand revenue. While our creator-focused D2C business sees revenue fluctuations due to seasonal factors and product variations, it maintains stable year-over-year growth. Let me share some case studies from our enterprise e-commerce solutions. First, in our global brand partnerships, we're supporting Benetton Group's Taiwan e-commerce operations. We provide comprehensive support for their brand, Benetton and Sisley's official e-commerce sites, including sales management through our AnyX platform. As a result, we've achieved more than 200% year-over-year revenue growth over the past 2 quarters. For cross-border expansion, I'll highlight our work with Korean cosmetics brand TIAIM in their Philippines market entry. We established their cross-border e-commerce infrastructure, including import operations, while providing sales management through AnyX, customer support via AnyChat, and influencer marketing campaigns using AnyTag. In Southeast Asia, social commerce, which integrates social media and e-commerce, is experiencing rapid growth, with live stream commerce at its forefront. The region's mobile-first generation, with their increasing social media and e-commerce usage, is driving strong growth in the live stream commerce market. Brands engaging in live stream commerce have faced challenges with securing live streamers and managing time and location constraints. To address this, we launched AnyLive, our generative AI-powered live stream commerce platform. AnyLive supports 7 Asian languages and enables 24/7 live stream capabilities. This allows clients to cover the entire Southeast Asian region while significantly reducing streaming costs. Additionally, the platform can automatically respond to viewers' comments in real time, enhancing viewer interaction and creating an authentic live experience that differs from regular video content. This drives higher viewer engagement and is expected to deliver superior performance metrics. Let me share a case study of AnyLive implementation in Thailand with Evian, a global beverage and skincare brand. By utilizing a hybrid approach combining AI avatars and human live stream hosts, we achieved a 3.5x increase in sales while reducing streaming costs by 90%. We optimized engagement and operations by deploying human hosts during peak viewing hours and AI-powered streams during off-peak hours. This strategy enabled us to significantly expand monthly streaming hours while maintaining cost efficiency. In addition to Evian, multiple brands have adopted this platform, with many successfully implementing this hybrid model of human and AI hosts for efficient and effective live stream operations. Looking ahead, we will continue leveraging cutting-edge technology and the expertise of our local specialists across Southeast Asia to help global brands establish competitive advantages in Southeast Asia's challenging markets. Let me now turn to our partner growth segment. This segment continues to demonstrate strong momentum with 56% year-over-year growth, primarily driven by our creator platform. In our creator growth platform, we provide comprehensive support for diverse needs, including monetization support for TikTok and YouTube Shorts, as well as music distribution services. As a result, we're steadily expanding our global creator base, contributing to business growth. For our publisher growth platform, while we experienced a temporary slowdown in Q2, we returned to stable growth trends in Q3. Gross profit has recovered to double-digit growth year-over-year. The number of contracted companies for the publisher platform, AnyManager, stands at 1,767 companies as of the end of the third quarter. Although there were some contract terminations with smaller business partners, the impact on revenue has remained minimal. Due to the expansion of transactions with existing customers in Japan and Southeast Asia, the average quarterly revenue per company has remained steady, maintaining stable growth for the business as a whole. In our partner growth business, we optimized data analytics and advertising design for casual games published by VGames, a company that is based in Vietnam, achieving a 41% increase in ARPDAU, average revenue per daily active user, within 3 months. Furthermore, leveraging AnyManager's analytics capabilities, user acquisition, and monetization solutions, we have fully entered the game development business. Our in-house developed titles have exceeded 3.5 million total downloads, contributing to publishing revenue growth while strengthening our client support expertise. To further enhance our development capabilities, we have welcomed Mr. Murakami as an advisor, who brings extensive experience, including leading game businesses that achieved over 1 billion downloads. We will continue to intensify our game development efforts to create globally beloved hit titles. Regarding our creator platform, our focused efforts on global creator acquisition led to continued significant growth in Q3, with our creator base surpassing 2,700 globally. We provide comprehensive support for creators across multiple channels, not only YouTube, but also short-form video platforms like YouTube Shorts and TikTok, as well as sponsorship acquisition assistance. As a result, we're seeing steady growth in new creator signups. While revenue per creator fluctuates due to seasonality and other factors, we've maintained solid year-over-year performance. Let me share some case studies from our creator support initiatives. First is our work with Takeshita Paradise, one of our signed creators with 1.67 million YouTube subscribers. We provide comprehensive support for Takeshita Paradise across both online and offline channels, from original content production to tour sponsorships and merchandise development. In summer 2024, they completed a national tour across 19 cities, attracting over 32,000 attendees. Next is our support for Good News from Indonesia, an Indonesian news and information channel. Through our assistance with content strategy, data analytics, and brand partnerships, they've achieved significant milestones, including earning the YouTube Silver Creator Award. Let me update you on our PMI progress for acquisitions completed since our IPO. DDI in Indonesia, acquired in September 2023, has achieved strong growth with revenue up 111% year-over-year and gross profit up 124%. Archie Digital in Malaysia, acquired in May 2024, is also showing solid performance with revenue increasing 40% year-over-year and gross profit up 50%. Both companies' integrations are proceeding according to plan, with synergy benefits exceeding our initial expectations. These acquisitions have strengthened our business foundation and are contributing to sustainable growth. The significant post-acquisition revenue growth is primarily driven by effective PMI initiatives. For acquisitions completed since our IPO, we've implemented several revenue enhancement strategies. We are strengthening cross-border e-commerce support for our group's brand clients while expanding e-commerce solutions through AnyMind's customer networks across countries. We are also deploying our proprietary solutions, including live stream commerce and AI live stream hosts. We're also focused on cost optimization through operational efficiency improvements using AI capabilities, consolidation of recruitment and HR functions, and optimization of group finance operations. These initiatives have enabled smooth integration processes that are progressing as planned and delivering measurable results. Let me explain how we're evolving our business model through AI integration. While we've traditionally provided software and operational support through our BPaaS model, we're now accelerating advancement in both areas by leveraging AI technology. On the software side, we're driving data utilization and productivity improvements through technology, from customer review analysis in NEX and generative AI-powered live stream broadcasts to automated PR content creation in AnyTag and short-form video generation in AnyManager. On the operational front, we're strengthening our client support framework by implementing automated content generation, pre-posting review automation, competitive analysis automation, and internal chatbots for enhanced knowledge sharing. Through this proactive AI implementation, we will further strengthen our competitive advantage in the Asian market. Finally, let me share specific examples of how we're improving operational efficiency through AI implementation. Our AI lab team, operating from dual locations in Japan and India, is leading both the integration of AI technology into our proprietary platforms and the advancement of internal operational efficiencies using AI. Let me illustrate this with our influencer marketing operations improvements. Using AI tools, we've automated the entire workflow, from market analysis and target identification to influencer selection, content generation, and pre-posting verification. Notably, in our content verification process, AI-powered automated review and reporting is estimated to reduce processing time from 90 hours to approximately 30 hours monthly per person, representing significant efficiency gains. Through this active AI deployment across our global offices, we're successfully achieving both operational efficiency and service quality improvements. This concludes our earnings briefing. Thank you for joining us.